Hello, in this lecture we're going to define closing entries. According to fundamental accounting principles, while 22nd edition, the definition of closing entries is entries recorded at the end of each accounting period to transfer end of period balances in revenue, gain, expense, loss, and withdrawals, dividends for corporations, accounts to capital account to retained earnings for corporations. What this means is the closing process is what we do towards the end of the accounting cycle. We are preparing the closing entries in order to prepare for the next time period, the next process. So that means we have to close out the temporary accounts. That's why the definition contains the temporary accounts that will be closed, including revenue, gain, income statement account, expenses or income statement account, loss, which would be an income statement account, and then withdrawals, which isn't an income statement account, but which is still temporary. And then we have the qualification of dividends, if we're talking about corporations, because corporations will have dividends rather than draws, as a sole proprietor would have. And we're closing those out to the capital account if we're talking about a sole proprietor. And then we have this qualification again being that if we're talking about a corporation, we would be closing out to the retained earnings account. So an example of this would be if we had the adjusted trial balance here. This is what we use to create the financial statements. Then we would post the closing entries, often done in terms of 4 steps: closing out revenue to an income summary account, closing out expenses to the income summary account, then closing out what's in income summary at that point, which would be the net income, to the capital account or retains earnings in the form of a corporation if it was a corporation. And then we would close out draws to the owner's capital account. Result being that we are left with, at the post-closing trial balance, after this closing process, nothing under the owner's capital account in this case, meaning the draws is temporary, it's gone. Income summary is a clearing account, it's gone. The entire income statement has now been made zero, including revenue and expenses. The point of that being that if we start the next time period, we need these temporary accounts to start at zero, so then we can count up the post-closing trial balance after the closing process being the permanent accounts, generally basically the balance sheet accounts.